What would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? If confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.
Currency market dynamics have been a key factor in gold's recent performance. Although gold had previously demonstrated resilience despite a strong U.S. dollar, recent trading sessions have seen the metal struggle to hold its ground. Technical analysis indicates several signs of oversold conditions, suggesting the potential for a support level to form. The psychologically crucial $2,600 mark aligns with the 100-day exponential moving average, a vital technical indicator supporting gold's upward momentum since March. Economist and best-selling author James Rickards has set an ambitious price target for gold, projecting it could reach $23,000 an ounce. He explains that this would be the necessary revaluation if gold were to back the US dollar in the future. According to Rickards, the calculations are relatively simple. By analyzing the money supply, specifically M1, which includes money in circulation and bank deposits, and comparing it to the total U.S. gold reserves of approximately 8,133 metric tons, it is possible to estimate the price gold would need to reach to support the dollar effectively. The United States M1 money supply reached approximately $18.15 trillion by September 2024, showing a slight uptick from the previous year. This modest increase follows a period of contraction in late 2022 and early 2023, which starkly contrasted with the dramatic expansion seen from May 2020 onward. The UK maintained about 20% gold backing for its currency, while the US had a 40% backing during certain periods. Using historical benchmarks, Rickards argues that a 40% gold backing is a reliable measure to maintain confidence in the monetary system. To determine the necessary gold price, he calculates the dollar amount needed to cover 40% of the M1 money supply. Then, he divides this figure by the total number of gold ounces held by the U.S. government. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
For a long time, go back 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of 7th grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. They have all. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves. But that money is sterilized. It's not doing anything. No one's getting to spend it, and there's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks, and that's M1. It includes bank deposits and so forth. So I use M1, and then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. And 8,133 metric tons. Break it down by ounces. Divide one by the other. How much gold backing do you want? Now, the hard shell Austrians will say 100%. If it's not, it's leverage. Or historically, that's not true. The Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%. They ended up at zero by the late 1960s. But it was either 40% or 25%. So take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard.
According to the latest interim silver market review from the Silver Institute, released Tuesday evening, the global silver market is expected to experience a physical deficit in 2024 for the fourth consecutive year, driven primarily by rising industrial demand. Global silver demand is projected to increase by 1% year over year, reaching 1.21 billion ounces in 2024. If achieved, this would mark the second highest level of demand since Metals Focus began tracking these metrics in 2010. James Rickards contrasts gold with silver, highlighting that while silver has historically served as a form of money, it also plays a significant role as an industrial metal. This dual nature makes analyzing silver more challenging. In times of economic recession, gold tends to rise as a safe haven asset, and silver generally follows suit. However, because of its industrial applications, a downturn can reduce demand for silver, causing it to temporarily lag behind gold's performance. Let's now turn our attention to the video again.
I spent a lot of time analyzing gold, not so much I do invest in gold mines. I've been in gold mines and know a lot about the production side of the business, but my main interest has always been gold as a monetary asset. The truth is gold's not good for much except money. I think it's the best form of money. But you say, well, what else can you use gold for? Well, jewelry. Well, okay, jewelry is just a form of wealth that you wear. You see an Indian bride draped in gold chains. It's beautiful looking. Yeah, but that's her dowry. That's her down payment on the house. That's the kid's college education. So jewelry is just just a different way to store bullion. But so gold is not good for much except money. Silver is different. Silver is a precious metal. It can be a form of money, has been, and still is, but it has a lot of industrial input. So when it's an industrial input. So when you're analyzing silver, you've got the precious metals analysis on the one hand, but you have industrial input on the other. And that makes it tricky because if you're in a recession, let's say the price of gold is going up, silver will tag along. Silver will be along for the ride. And you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver. But the other thing I do is I offer investors a suggestions for part of their portfolio, not all of it by any means, but have a slice of precious metals, have some silver, some gold, fine art, land, natural resources, alternative investments, etc. Have a set of assets that are, first of all, hard assets, meaning non-digital. I'm not saying all silver and gold for sure, but have these other things as well. But the point is non-digital assets that are not going to be frozen or seized or caught up in the kind of collapse or vulnerable to the power grid outage. I have all these Bitcoin people. I'm like, how does it work when the power's out? The point being, it will protect you against the kind of scenario I'm describing. So again, diversify your portfolio in a way that makes you less vulnerable. And for the regulators, think about a cybernetic approach that could be less of a blunt instrument than slamming on the brakes. And that may be the best we can do. But the real best we can do is to understand the danger. Like I say, I'm not saying get out of the stock market. I'm saying I'm warning people. These are landmines that you need to be aware of.
Precious metals declined last week due to rising bond yields and a stronger dollar following Donald Trump's re-election to the White House. Additionally, the Federal Reserve lowered interest rates by 25 basis points last Thursday, meeting economists' expectations. This marked the second consecutive rate cut by the Fed, following a 50 basis point reduction in September. Typically, lower interest rates are seen as a positive factor for gold and other precious metals. What role do you believe precious metals should play in a diversified investment portfolio? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.